I'm gonna let you see my process of looking at companies. Trying to look at really good companies. So I use Simply Wall Street most of the time when I'm screening for companies. And so what I do in the filters is basically I want the market cap not too low, so at 10 million at the least, because I'm not really screening for penny stocks. Then I want the future growth and not more than negative 15%, because I understand this year has been very bullish, or at least 2020 was very bullish for companies, and so they may have a little bit of decline in growth, which I just don't want to be more than 15% because that wouldn't be good. And then the 3-year earnings growth, I don't want it to be any decrease at all, because I don't want that at all. Then I want the insider buying ratio to be pretty good, and I don't want any OTC stocks, because I can have another filter for that or make another screener for that, or I can listen to YouTubers, find that. Then I want it all in the United States, because honestly, I'm really just screening for those type of companies right now. And so what this is a high growth undervalued stock screener, so I can find 3 pillar stocks, which are companies that have earnings growth and or revenue growth, companies that have insiders heavily invested into, and then companies that have the market cap correlation is pretty good. Usually when the insiders are buying that much and it has that growth, which I put in those filters, well then they will really, most of them will pass this 3 pillar thing, at least the 2 pillars out of the 3, which is good enough, because that means it's good enough for me to research a little bit more, at least. So as we see, Curiosity Stream, like one of the first ones there. But that's not how I found this. I actually found Curiosity Stream by Rex Finance, which is an amazing YouTuber. I definitely recommend you subscribe to. Then we have Doordash. Doordash is amazing, but as you can see, the value score isn't really there. That means it's not undervalued. And then there's a bio. I don't like anything with bio in it because I'm uncomfortable with that. I don't understand it. It's not in my circle of competence, and so I try to stay away from it. Carnival Cruise Lines, it's not a very healthy company. Never want to invest in unhealthy companies. And just in my opinion, it's like, why would you do that? So you can see I like companies that look like this. Kind of like Curiosity Stream does too, where they have a pretty good feature score, pretty good value score, and a very healthy company. I don't really care about the past, and I don't care about dividends because I'm not a dividend investor. I'm a growth investor, or growth size value investor, and I invest for the long term and hopes for short term gains, like Rex Finance likes to put it. As you can see, I really do love Rex Finance's YouTube channel. So all these things are bio right there. Not really interested into that. This is not undervalued. Cloud-based software platform for digital advertising. Kubient. Let's just see what this is. So I click it. I press search real quick so that I can go in a new tab, so I won't lose that spot. Because if I just click it, it'll go right into there. It takes a long time to load, but it's okay. It's all good. So, oh my gosh, revenue! I've never seen that with the company. Revenue grew more than 1,000% over the past year. Well, not with most companies. I don't see this. Earnings are forecasted to grow 57.26% per year. It's trading at 92.6 percent below the estimate of its fair value now, and they have all this, and it's a healthy company. I don't know how that's true. So, trading on the NASDAQ, the NASDAQ has been very bullish lately. That could mean a crash or so. But, past is also not indicative of future results. Don't really look at that. Far more money has been lost trying to predict the future, so don't do that. So, Kubient develops a cloud-based software platform for digital advertising industry. The company develops Audience Cloud, a platform for real-time trading of programmatic advertising. Its platform, I have no idea what that means. I need to search it up. Its platform allows advertisers and publishers the ability to use machine learning during programmatic ad space auction. The company was founded in 2007, so very recent. 2017, which is a very recent company. That means it was founded 4 years ago, and it's based in New York. So let's search pragmatic. So I'm going to copy and paste this. So pragmatic definition. Oh, they have advertising right there. I don't know what that means. So pragmatic. What does this mean? Of the nature of or according to a program, schedule, or method. So yeah, that's what that means. Now I'm going to go to advertising definition so I can see exactly everything. So pragmatic ad buying typically refers to the use of software to purchase digital advertising, as opposed to the traditional process that involves RFPs, human negotiations, and manual insertion orders. It uses machines to buy ads, basically. Oh, so I kind of get it now. Let's look at some images, because sometimes they have visual charts that make it even more understandable, if that's even a word. So it's kind of okay. So there it is. Okay, I can see that it looks a little bit better. kind of understand it. I would have to research this a little bit more, but this is just quick. I'm just trying to show you looking at a company. So high volatility, that kind of sucks. That's kind of why I wanted a 10 million plus market cap, so I won't have that, but it's all good. It's not that bad. It has a market cap under 100 million at 63 million, so I'm not really worried about that, and I'm not worried about the revenue is not a lot. I'm not really worried about that, but the high volatility is a risk. It says really the only competitor they see is Trade Desk, and a lot of people like Trade Desk. So this is what Simply Wall Street says. This company is high growth potential with an adequate balance sheet. So I think that's great. So we can kind of see in the past how much it hasn't moved. It's moved a lot. You can kind of see why it's moved. So that was the past year chart. Now I'm finna go to the max chart, or I'm about to go to the max chart. Let's go back to 1 year. I guess it's only been public for 1 year or so. So it seems like the max price it was at $8.66, and the lowest price it was around $2.23. And you can see it had capital raising, so it went down. Then you can see your earnings update must have really good earnings. Then this one must have really bad earnings, so obviously their earnings are very volatile. It looks like, but I have to check that to make sure. So the price is around $6. The fair value is around $75. Really good margin of safety, like that from the start. Obviously not profitable. The P ratio is negative, so you can't calculate the PEG ratio. Essentially, the PB ratio is higher than the industry and the market by a good bit. Not worried about that, but obviously it looks like in the next 3 years it's expected to become profitable and very profitable. So we see the earnings is expected to be around 20 million and revenue 44 million, and that is basically in 2026. So let's look at that. You scroll all the way down so you can see the market cap. That's the first thing I want to see. 2020. So it said 20 million by 2026 basically. So let's look at the market cap right here. So that's just the earnings. That's going to be the earnings. 20 million, around 21 million or 20 million by 2026. So what is that? 5 years from now? So if you hold this for 5 years, you basically, P ratio of 3, essentially. I think that's really amazing. But you never know. This company, so let's look at the insider ownership, because that's also one of the pillars I like to see. Individual insiders own 38.3% of the company. Amazing. Institutions don't own a lot. When institutionals get into it, they're gonna really, that's really good that you can get into a company before institutions do. And the insiders are already obviously in there a lot. Paul Roberts, he owns 27% of about 28% of the company, and he's the CEO and founder of the company. Then the member of board of directors and director, he owns around 3% of the company. And then you can see some more insiders owning a good bit of it. I like that. I like that a lot. So NASDAQ, Interactive Media and Services Media. I don't think we see much never mind. Then you see shares outstanding. Not a lot of shares outstanding, which kind of sucks, but that's okay. Based in the United States, I was only screening for companies based in the United States. So you can see the actual number. It's $17.4 million for Paul Roberts. And have they been buying? Yeah, they've been buying too. There's only one reason why you buy a company. It's because you think the stock price is going to go up. There's only one reason why you sell a company. Just kidding. There's many reasons why you sell a company, but only one reason to buy it. I love saying that because it's so true, and it's why I really love looking at insider ownership and insider transactions that are buying. I don't really focus on insiders selling, especially if they already own a significant amount of it. I'm just worried about insiders buying because that just makes me even more bullish. And that was actually very recent, like 0 to 3 months they've been doing that. And who was it? Let's see. Peter Board, which is the member of board of directors. This was in early October, and he's member of the board of directors. So that's good. The CEO compensation, not really worried about that, because he hasn't really been CEO for a good bit of time, and so and it hasn't really been public for a good bit of time to even test that. No dividend yield, great. Just kidding. It's not that bad. It's not that good. I don't really care. For example, Walgreens Boots Alliance is a pretty strong company, and it doesn't have a dividend. So debt to equity ratio satisfactory. And they're saying insignificant data, which is true, but honestly it doesn't matter because the debt to equity ratio is good. The short-term assets exceed their long-term liabilities, and their long-term assets exceed their long-term liabilities. That's what I'm worried about. That's great. Not profitable, so I'm not really looking at all of that. And so far from a quick glance, this company looks very, very intriguing. And so, yeah, this looks very, very intriguing. This is probably a company I would want to go and research more. Thanks so much for watching. That's kind of me screening companies, and there's many other companies that you can see. I will have a link to the screener if I remember. Thanks so much for watching. Make sure to subscribe and hit the like